So it's nice to be here. Thank you so much. My name is Lori Fuller, and I'm an LP and portfolio advisor with Launch Africa.
Hi, everyone. My name is Hangui. I am an investor with Commerce Ventures. We are a fintech specialist fund.
Great. Good afternoon. My name is Tesh Babu, co-founder and CEO at MarketForce. We are supporting neighborhood merchants with access to inventory and financing in Africa.
Thanks so much, guys. And my name is Aparupa Chakravarti. I work for a company called Bolto Emerging Markets Group. We are a strategy consulting and investment advisory firm, and I will be facilitating today's conversation. Today, we're going to be talking about a very important topic. Well, at least in our opinion, maybe we're biased. But the premise of this conversation is that money does not always flow in the ways that it should be within the startup ecosystem of the region. And from that point of departure, we're going to have a conversation at two levels. At the micro level, we're going to touch on the realities of the day-to-day challenges of fundraising and also deploying funds towards startups in the region. And afterwards, we're going to broaden the scope a little bit to look at the ecosystem as a whole and what are some of the levers that are being pulled and maybe need to be pulled in order to get capital to flow in new, different, and worthwhile directions within the broader ecosystem. So to begin at the micro level, I'd like to open up with a story. And the protagonist of the story is a young woman called Wambui, for argument's sake. This is a fictitious character, so it's not based on true events. But the story I'm about to say is probably going to be relatable to a lot of people who are in similar circumstances within Kenya, within the broader region. Wambui runs a company. She's a founder of a startup, and it's doing quite well. It's revenue positive, modestly profitable. It has all its fundamentals in place to be attractive to investors for the $1 million that she's looking to raise. Very quickly, Wambui is able to generate genuine interest from a small pool of investors, LPs and VCs. Among the small pool, there's one LP that is particularly interested in Wambui's business, is very responsive, very engaged, and is giving her some really fantastic terms. The others are great, but not as attractive nor as engaged as this particular LP. Let's call it LPX. So Wambui's talking to LPX, responding to all their questions, they go back and forth, seems to be going well. Fast forward 6 months. 6 months down the line, LPX comes back to Wambui and says, it's a no-go. Within those 6 months, all of the other investors who had shown interest in Wambui have also dropped off. So Wambui is now back to square one. My first question to you guys, and I think I'm going to lob it to you, Tesh, first, is from your perspective, as a founder, as an operator, as someone who has successfully raised money for your business, what do you think Wambui is thinking in terms of what happened, what went wrong?
Yeah. So yeah, it's a great question. I think so. The assumption, talking to based on my experience when I was raising my pre-seed round, I thought that all or most of the investors I was talking to had cash in the bank. That's one, and I did not realize how many founders or startups were trying to get their attention or trying to close them. So I think depending on the stage, I would think they lost interest because I'm not good enough as a founder. Maybe one. If I'm later stage, I think maybe they're not seeing the right potential in our business, the potential that our business has. But then today, I think about it differently. I think it could be that I'm actually thinking about my business in a silo I kind of have tunnel vision. So that means, because most investors don't tell you the real problem, unfortunately. So you end up really second guessing yourself. You don't know what the problem, why you didn't close the funds. So in that case, I think as a later stage founder, I try and really dig and ask for responses to investors like that. Like, what can I fix, for you to come through? So, yeah.
No, thank you. That's fantastic. And I think you draw some very important distinctions between what stage of funding you're at, the maturity of your business, and also being able to put your business in a broader perspective. Hangui, from the perspective of the VC in this scenario, what do you think happened?
So for the purpose of the discussion, I think we're talking about the flow of capital. I will make some assumptions on your scenario, one of which is that the interest from the VC was genuine, and that they did want to go ahead with the investment, but somewhere along the line, they dropped off. Now, I have seen multiple scenarios where investors are well-intentioned, have the intention at least definitely of investing into the investments or the startups that they're coming across. So in Wambui's case, it could have been that the investor didn't actually have the capital. So a lot of the time when we say, oh, we have a $100 million fund, most people don't realize that they're actually still raising that capital, and it's more in the promise of, I will have a $100 million fund, or sometimes in the case of and others, yes, sometimes the case of angel investors. I've seen or heard examples. For instance, on Monday, we were having a discussion about an angel investor that was meant to invest into a startup, but they had their capital tied up in something else, and they were trying to release that. But due to circumstances that were genuinely beyond their control, they weren't able to release that capital, but didn't communicate that to the startup or the entrepreneur that they were in discussions with. Now, yes, there is a question of why is there not more transparency from the VC's perspective? Why do startups not ask more questions around, like, well, do you actually have the capital, or is this something that you are hoping to get down the line? What I think maybe we don't pay enough attention to, maybe from a founder's perspective looking at VCs, is that VCs are also often startups themselves. They're also raising funding from external sources. They're building a business, right? They've got a product, and that product is funding. Their customers are the founders and the startups. Now, how many founders and entrepreneurs in the room have had challenges in the back end that they would never directly relay to their customers on the front end, but spend a lot of time trying to solve for those? And yes, at some point, you get to a point where you're like, you have no choice. This is not working. I cannot deliver on X. But until you get to the point where you absolutely have to disclose, you're going to delay, you're going to stall, you're going to do everything in your power to make sure that you're able to deliver what you had promised to. Sometimes investors are going through the exact same thing. They are raising funding on the other side. They've hit some issues, stumbling blocks, and are trying to deliver that capital, but for whatever reason, they're not able to. And then 6 months down the line, it's, I'm sorry, Wambui, I can no longer invest.
And investors hold a lot of power in this way. And like customers who can pull out, like startups normally, like I really, at least at the very early stage, a lot of startups are desperate. So the investors hold a lot of power in that case, which is unfortunate for the case of Wambui.
No, I was also about to pick up on first of all, yes, the power dynamic, and also something that you both said, which I think is kind of two sides of the same coin. You talked about how it's very possible that you assume that you're not good enough depending on where your business is, and this kind of like almost a self-critique. And then you talked about a baseline assumption that the intentions were good to begin with. And I think that element of humanization may not always happen in situations where, first of all, there's a power dynamic, and maybe there's also a sense of prioritization and urgency which may not align depending on the startup and the VC in question. Thanks a lot, guys. Lori, from the LP perspective, over to you.
Thank you. Maybe I'll just build on a little bit of what was said here. There's so much of an opportunity for more transparency in this space, right? And when I was listening to the story and I was listening to both of your comments, I thought, this is a great business opportunity, right? How we have so many companies that look at technology to enable transparency and data. And I'm thinking, ultimately, this is kind of what we're talking about, right? Where's the transparency? Where's the information sharing on both sides? And where's the communication, right? And do we really understand the business models of both parties, right? Both the needs of the entrepreneur, but also, as you suggested, how the VC runs, and are we sharing all that information? So clearly, there could be an element here of investors behaving badly, just from a communication perspective. But I do think it's a really good point around it's not personal. So many of the entrepreneurs, because they work so hard in building the business, often their identity is tied to the business, which we understand. But it's not about that particular entrepreneur or that particular company necessarily. But I do think there's an opportunity here for more transparency and just more communication. And the fact that we're still having these kinds of conversations means that there's a real opportunity for improvement.
And I guess in the spirit of transparency, and I suppose this is why such a conversation is interesting and also important, because it's not always that you get to have three people wearing these three hats sharing a stage and having this kind of a conversation, right? Or if you're doing so, it's low stakes because there isn't an actual deal on the table. Having shared these perspectives in terms of what has happened, was there anything that has come up so far that may have surprised you, or maybe you don't necessarily agree with based on the hat you wear and the perspective that you represent? And this is for all three of you.
Personally, I think and I understand why you would say that the power dynamic sits with the VC. I don't necessarily agree. I think that there are times in different stages of deals where there may be a slight imbalance, but I don't think it sits entirely with the investor. I think founders and entrepreneurs underestimate how much power they actually have in a discussion, right? How much they should be. And I always say this, in as much as like if an investor is screening an entrepreneur and doing DD, as a founder, as an entrepreneur, you should be doing the exact same thing with them, asking them questions in terms of if they're thinking, why should this company be in my portfolio? Or why should this investor be on my cap table? You have those options. You have the options to challenge what the investor is bringing to the table outside of capital. And yes, there are instances where, if you're coming from a point or a perspective where you absolutely need money, and you're in a desperate situation where you would feel that the balance of power is skewed outside of your control. But I just want to remind founders and entrepreneurs to not underestimate just how much power and intention they can have in their own negotiations for deals.
Oh, go ahead, Lori.
Well, I was just going to build on that. I also think there's a little bit of a coordination challenge or coordination problem. And what I mean by that is there's multiple investors often that need to invest in a certain deal. And so the startup is coordinating several different potential investors to invest at one time. The LP or the venture, they also have a pool of money of which they are talking to several different startups that they also may invest in. And so you start to see the complexity of the coordination and the communication in a very fluid and dynamic environment, because each person in that relationship is coordinating several different individuals or companies at the same time. And of course, there is a time pressure here, or a time element. So it's easy to see how it could get very difficult around the transparency and the timing and the proactiveness that we want. We can easily see how this could get really difficult. No excuses, but we just need to figure out a good, consistent way that we can all move forward so that these types of examples don't continue to happen.
Tesh?
Putting me on the spot.
That's kind of the point.
Yeah, I think, honestly, very different perspectives, as you can see, from a VC and from a founder. Personally, it was very tough to raise our initial rounds of funding. And for us, it was clear that the power lay on the other side. We didn't have that many options. And unfortunately, in the continent, today, even going into a later stage, there's still a handful of investors who can invest in the business at our stage, because we moved from being too small, too early. The next time we went to raise funds, we're told we're too big, too expensive. So there's clearly a gap in terms of how investors look at startups and the other way around.
Can I ask a question on that, right? So do you feel, as you've progressed and grown the business, that balance has shifted for you from your perspective?
I think we're getting to a balance. It's not tilted yet. We're getting to a balance now. The idea is to make the business really successful, that when we go to the next stage of funding, then at least we're able to have multiple term sheets, for example, to choose from, right? I think that's at the point where the scale tilts. Yeah.
And I suspect, like all things, this is not binary, right? I suspect there's a combination of elements about the individual and elements that are also structural, and it's always going to be a push and pull between those two things. I would love to keep going along this track, but unfortunately, in the interest of time, I'm going to pull out and zoom out a little bit and go to some of the ecosystem considerations that we want to talk about today. So, just a quick a bit of context. Africa right now is on the same startup funding trajectory as Southeast Asia and Latin America was 5 years ago. And if anything, it's actually on an even accelerated track, at least compared to Latin America. And this uptick in activity is fantastic. It's super, super promising. But there are some things within the funding landscape that points to a certain level of disjointedness. One is a lack of diversity in terms of funding sources and where and to whom money is going towards. The other is an uneven distribution in terms of where capital is going across different ticket sizes. So for example, in the past year, while there were 600 deals in the ticket range of $0.2 to $5 million, there were only a comparable 150 deals in the $5 to $50 million range. So we're seeing that there's a distribution issue, one way or the other. This question is for both of you, Hangwi and Lori. What would you say are some of the main contributing factors behind this uneven spread of capital, both in terms of across ticket sizes and the value chain itself, as well as in terms of where capital is going to and from where?
I'll start, but I'm then happy for you to join in. The first thing I do want to say, as we were talking about this previous example, that I think is important to say, is that we all in the ecosystem, the startup ecosystem, we do need to be founder first, right? Because we only succeed as investors if the startups in the ecosystem succeeds and grows. So I think that it's fair to say that we always have to step back when there's problems and inefficiencies in the model and just make sure that whatever we're doing is absolutely founder first. I think that, to me, is a very important North Star, if you will. I think the thing around where the money is flowing and the fluidity, I think also there are different capabilities that are required, that value add besides just the money, and those change over the maturation of the startup. And where I think there's an opportunity, and I'm pretty excited, at least from my view, is that the angel scene and the early stage investing scene is really starting to grow and formalize. And so angel networks that might be regionally focused are now developing ties amongst themselves. And what I think is really important and is happening, but can we accelerate that impact? We talked a little bit earlier about the acceleration. Startups that are and founders that are successful, how quickly can we start giving back, right? And how quickly can we start investing in, more of our peers that are going through this journey? And I think that also for women, right, there aren't enough women investors, women LPs women venture partners. We know each other. How do we continue to build that community so that we make sure that others that are coming into that community have the visibility and we share the contacts and the resources that we have? So I think what's most important is we build on the momentum. And even though it starts small, it continues to grow with this virtuous cycle that we must continue to sponsor and support. People have to believe that investing in startups is not only good for the continent, but it's also a good investing alternative. And traditionally, a lot of those, there's some education, I think, to do there, because that's not necessarily where investors want to put their money first. It could be land, for example. So how do we educate so that we get more investors coming in and understanding where the opportunities are and what the impact is that they can actually have on the ecosystem?
And to add on something that you mentioned around particularly the different skill set that is required at different stages, right? So I think one of the things you were alluding to was that there are a lot more deals that are happening at the much earlier stage and where that comes from versus deals that are happening at a much later stage and where that source of capital is coming from. You will likely find, and I haven't looked at this in exactly, but you will likely find that a lot of the deals that are taking place at an earlier stage are being funded by what you would term as local capital. A lot of the deals that are taking place at a much later stage is then what you'd probably term as foreign capital. The reasons for this is perhaps tied to what you were saying around the skill set required. The earlier the business, the more sort of localized the context, and therefore a lot more understandable by local investors. The later the business, sort of the more established and mature, it's gone down its growth stage, the more it starts to look like other things that foreign capital may be able to relate to much better than it would at the very early stages, right? So there is a sense of investing into what is familiar, what you can understand at a localized context, and that also would influence some of where the capital comes in at different stages, right? The other thing around maybe the number of deals that are happening, I think given where our ecosystem is and where we are in our trajectory, it makes sense that you're seeing a lot more activity much earlier on and a lot less as the deals get bigger, as the startups grow and mature, because a lot of startups are still exactly there. They're still starting, they're still growing. They haven't necessarily reached the Series C, D stage of investments where you see much later stage deals going on. That will change. I think that will, as we grow in our trajectory, that will continue to evolve. But where there is still, from the founders and startups that I've spoken to over time, still quite a bit of a gap is what you alluded to earlier, where there's quite a lot of money in the very early stages and enough in the later stages. But there's this weird missing middle where or you're too far gone or you're too early, right? And it's like, yeah, it's like there's a lot of startups that I've spoken to where, like, yeah, it's a bit too early for us. Have you tried speaking to, a Launch Africa? Like, yeah, we did, and we're too late for them. So where do we go? Find us, right? So that's
there's a name for that. The valley of death.
where startups go to die.
Not ominous at all.
Right. So I think you have about 5 minutes to wind up. You want to finish up with final?
Sure. I'd actually like to toss one last question to Tesh. And then maybe, Tesh, you can keep it to under a minute. So if there's any audience questions, at least we'll have one or two from the audience, if that's okay. Yeah. So putting theory back into practice, you raised $40 million in your Series A for your company. And I just wanted to ask you very quickly, what are some of the contributing factors that led to that successful raise that are maybe one or two that are particular to you and your company, and maybe one or two that could be generalizable as lessons for other startups who are going through their own fundraising journeys?
Yeah, I think two things come to mind. One is getting a tribe of investors. early on who really believe in you, because they are the guys who we talked about launch, Future Africa. There's a couple I can talk about, Sylvan, Viban in the room. There are a couple of investors early on who really support you as you get on to the next stage of the raise, and that means making the right introductions to later stage VCs, etc. So that's one thing that worked well for us. I think one that was particularly unique is the fact that we had a lot of strong support. So when we went out to foreign investors, like investors outside the continent, for example, a lot of them didn't have context of the continent or what we're building, and in that case, it felt like there wasn't enough. They have enough capital, but they don't have enough conviction to invest in Africa. But again, the same set of African investors who really believed in us, the guys I call our tribe, then said, we need to get this company to where it's going, and that's because there was significant traction. They could see the potential. So that was unique. They rallied up and helped us with the Series A.
That's fantastic. Thank you. Are there any one or two very quick burning questions of the audience? Oh, guess we have one there and another one there.
Hi, thank you. My name is Frank Dea. I run fintech and blockchain incubator. And my quick question, actually, I'm also in the process of raising at the moment. My quick question would be, what are like the major, what we would describe as a red flag from an investor, which founders and startups need to look into?
A quick red flag is the fact that you're holding a Minion bunny. I don't know if I'm the only one who saw that. I was like, what is that you have? Like, what is going? I'm sorry. Yes, please do answer your question.
That's a story for another day. Whichever one of you would like to take that.
Is a question like from a founder perspective or from an investor perspective?
I think both of them make sense because you're probably looking at the same thing.
Okay, does anything come to mind? I think investors who give you criticism that is not constructive. So it's great to get feedback where the investor is telling you how you can improve, rather than hearing something like this will never work, which is something an investor told us. I was like, whoa.
I'm sorry.
Name names, bro. Just say it.
Yeah, that's terrible because you can't introduce that investor to any other founder. But if they give you constructive criticism, you know where you can improve, then, there's progression.
And as investors, what do you look at and you're like, definitely not?
I think it's more of just the approach. So, it's the well-worn adage, ask for money, you'll get advice. Ask for advice, you'll get money. Now, we have to have advice that's actually practical, but we also, we approach it as a partnership because if we do engage, it's longer term. So I think it's the willingness to have a conversation, right, and spend some time getting to know each other. It's a means to the end. The end is hopefully, we fund you and we are partners because, as you said, it never ends, right? The first investment, you've got to support that portfolio company, it's founder first. So I think it's just the willingness to have the conversation initially, understanding that we're both putting time into that, and it may or may not at that time end up in a way that you think is successful, but maybe later on it was time well spent.
Hungry, would you like to add anything to that?
Yeah, maybe one of the key red flags for me is it's very easy to spot someone who is more in love with their solution than they are with the problem that they are solving for. So,
Okay, just read. Say it slowly, because that one is really good. Just say it very slow. Like nursery school energy. Just repeat. Right.
Repeat after me. Yes, I think it is immensely important that you are more rooted in the problem that you're solving for. It gives you the flexibility to be able to be dynamic, right? You are operating in a world where things change all the time. But if you're stuck on your solution because you think that is the answer, and the problem, if you haven't understood it properly, you'll never be able to adapt to a changing environment, to a changing problem, in essence. So that's a quick red flag for me.
Mr. Minion, I hope you have been served. power to you, and banana. Okay, there was a gentleman in red. There you go.
Yes, my name is Kimali, and I'll just give my experience shortly and then the question. So there was this time I went for a pitch, and I was pitching Speed Governor. I'm an engineer, so I make IoT systems. And one of the questions that I was being asked, what's the market size and all that? I'm an engineer, I don't know those things. So I failed. But then during that pitch, there was, this businessman, and he liked what I was doing. And he later approached me, and finally, we got to do a Speed Governor with him. So he invested in me, knowing that it may fail, but later I developed the Speed Governor, and we took it to the market, and it became one of the best Speed Governor in Kenya then. It was called Omata Speed Governors. So my question to you investors, because I'm just thinking, for us engineers, it's very hard for us to convince you about the things that we are thinking and we believe that will work. Because sometimes when we come to pitch to you, you ask about the market size. We are more focused on, if I make a TV and it works, that is I'll feel like I have achieved something. But then when it comes to marketing, it is not our forte. So what are you doing? Are you really investing in R&D, especially in Africa? Because I have seen this in first world countries. They invest in R&D. If something that doesn't work, it's okay. But in Africa, it doesn't work like that. Why?
You see why I told you to say it slowly? You see now? Yeah.
Laurie and Hagui, would you like to address that?
Well, I think it's a congratulations, actually, because your story is a success story, if I understood correctly. So everything ended in a good way for you. So I'm glad to hear that. We love engineers, of course. We love technical talent. That's one of the first things we look for is, so the red flag would be if you are bringing a technical solution and, you don't have a solid tech team, right? Or a solid engineering, team, one or two key people. So we know that those are absolutely critical to the success of a company, a startup. At the end of the day, I'll speak for the venture funds, right? They have an obligation to LPs like myself around returns. And returns come with the market size and scale. So we're trying to balance everything, right? We're trying to balance and respect what you bring as the engineering talent to enable the problem that you're trying to solve, a solution to that problem. And then at the same time, we're trying to understand the real opportunity so that we can see if it can achieve scale in a way that can meet the commitments that the fund has back to its LPs. So, there's art and science to that, but congratulations on what happened to you and the product.
I guess if you came to me and said that you built a TV and that it works, then yes, congratulations. But then my question to you is, why did you build a TV? Who is using it? What for? Where does it benefit anyone in that ecosystem? So if you're not able to answer those questions, then all you've done is build a TV for yourself.
I think I'd like to say something very important.
I know your time is finished, bro.
Please let me just say something important for entrepreneurs, because I had, I
Did you have a similar experience?
No, I understand his point of view, but I learned quickly that I thought entrepreneurship was like a single variable problem. I have this cool product and the world will love me for that, will love the product and use it. And then I quickly realized entrepreneurship is a set of hard variable problems. In this case, you need to build a product, you need to know your market size, you need to find investors, you need to build a team. And that made me just appreciate that you just need to upskill yourself, learn all these different things, especially if you're going to be a founder.
Yeah. It's not enough. You'll always learn that it's not enough. If you say, I'm an engineer, give me money, it's not enough. Yeah? And all of us, I've been doing this 17 years now. And I can guarantee you, I know how to code, I know how to build, I know how to design, I know how to build a team. It's still never enough, right? So it's always about building a team. Bro, No, you can't ask the question. Time is up. Okay, be quick though. Be quick.
Okay, thank you. Hi guys, how you doing? My name is Abdullahi Mahmoud. I'm from Microsoft for Startups.
Okay,
So
slow down. That was too quick. Just start again. I was
Okay,
like,
okay.
Be quick, not too quick.
did you hear anything he said? Man, I said, I had my slow. Okay, let's do it again. Slowly.
Okay, hi guys. My name is Abdullahi Mahmoud. I'm from Microsoft for Startups, whereby we build tech ecosystem for founders, and we also help them connect with venture capitalists. So my question to you guys is: there's a system of fundraising that we've started this year. It's called tokenizations of assets, whereby we help startups raise funding through tokens. So I'm asking you guys: do you guys think this is a good way, like for African startups, to raise funding?
The Web3 question. It's about time. I mean, it's been 2 days. Nobody has talked about it. Web3 tokenization, and WeFunder is actually a really good solution. Kickstarter kind of started it a long time ago. If we can't raise money from people like you, can we raise money from people like them in crowds? Is that a journey you see happening? I know it's competition for y'all, but then thoughts?
I think it's a great strategy for B2C companies, especially. I think that's all I can say. I do see it happening.
All right.